Welcome to Uncovering Trusts, a podcast by Edison Group, a content-led IR business integrating analyst content, digital targeting, and investor engagement. Each episode will uncover the distinct features and latest developments of a selected listed investment company. So tune in to find interesting investment ideas and to stay on top of what is happening in the investment company sector. I'm your host, Suki Thompson, and today I'm joined by Joanne Collins, an analyst at Edison Group, who will talk about Murray Income Trust, known by its ticker MUT. Joanne, thanks for joining us today.
Hi, Suki. Thanks for having me.
Please can you start by providing a high-level introduction to Murray Income Trust for those listeners less familiar with the fund?
Yes, of course. The trust invests in high-quality, mainly UK-listed stocks such as Unilever, AstraZeneca, Diageo, and BP, although usually about 15% of the portfolio is comprised of overseas names. It aims to produce a high and growing income combined with capital growth, and it has achieved both its dividend and capital growth objectives over the long term.
So which investors are likely to find the trust most appealing?
I think the clue might be in the name. Murray Income is most likely to attract the attention of investors seeking a regular, competitive and rising income, as they will appreciate the trust's commitment to annually increasing dividends. It may also appeal to those seeking exposure to a diversified portfolio of high quality, resilient and mainly UK stocks. The trust is diversified by sector and by income source. 80% of all portfolio income is sourced from abroad, from both its UK companies' overseas sales and from the earnings of its holdings in non-UK businesses. This provides significant protection from any deterioration in the UK's economic climate.
Speaking of portfolio revenues, I understand that MUT has another means of diversifying its income source.
Yes, it does. It has a program of option writing which provides a further modest, uncorrelated supplement to portfolio revenues. And importantly, income from these transactions also gives the manager scope to invest in companies with lower starting yields, but attractive dividend and capital growth prospects. Income from option writings totaled 1.7 million in the first 6 months of this fiscal year, representing about 10% of total portfolio income over the period. Recent positions have included calls on Experian and Microsoft.
Income is clearly an integral part of the trust, so let's now focus on Murray Income's dividend history.
Sure. The trust boasts 50 years of continually rising dividends. It paid a dividend of 37.5 pence per share in its last fiscal year. This is up from a dividend of 36 pence in the previous year. And the board has indicated that dividends will rise to at least 38 pence in fiscal year 24. This represents a prospective yield of 4.5%. The board has also reconfirmed its intention to maintain annual dividend increases as a priority in the future.
And I believe there has been a recent change in the way the trust pays out its dividend?
Yes, that's correct. Late last year, the company decided to try and smooth its quarterly dividend payments to allow shareholders to access dividend income more quickly and more evenly throughout the year. In effect, this means that the first 3 dividend payments for this year will rise to 9.5 pence per share compared to last year's first 3 interim dividends of 8.25 pence per share. And the fourth dividend for the year will be lower than last year's 12.75 pence per share. However, the board expects the fourth dividend for this year to be at least 9.5 pence. This will give an expected total for the year of at least 38 pence, representing a rise of at least 1.3% on the fiscal year 23 dividend.
And how about Murray Income's performance record?
It's good long term. The trust has delivered absolute gains and outperformance of the market over the longer term, returning an annual average of 6.1% in NAV terms over the 10 years to 31 March 24, versus an average market gain of 5.8% per annum. However, the trust quality bias has meant that more near-term performance has lagged the market slightly, as value stocks have outperformed. It returned a respectable 7.8% over the year to 31 March, although the benchmark return was somewhat higher at 8.4%. The share price return over this period was 2.4%, widening the trust's discount to NAV. It's important to note that Murray Income has done well compared to its peers in the AIC equity income sector. It has outperformed the average sector return over the short term and the longer term and is ranked in the top 3 performers over 10 years.
Let's talk a little bit about how Murray Income compares to its peers.
Of course. It's one of 17 members in its AIC sector, although it's differentiated from many of its peers in several respects. While Murray Income is focused on companies with high quality characteristics, several of its peers have more value-oriented investment approaches. The trust portfolio is more diversified than some across sectors and stocks and geographies, as around 20% is invested in mid-cap stocks, and it can invest up to 20% in international names. Murray Income's merger with Perpetual Income and Growth Trust in November 2020 doubled its market capitalization, making it the 5th largest fund in this sector. And its ongoing charge is the second lowest amongst peers following the merger, reflecting the benefits of its scale.
Clearly, MUT's overseas holdings are a differentiating factor. Could you tell us a bit more about why a UK-focused trust might want to hold onto overseas stocks?
Sure. As I mentioned, Murray Income has scope to invest up to 20% of gross assets in overseas listed companies. The idea is that this provides the managers with flexibility to access industries not available within the UK market, and also to diversify income and risk and to invest in better quality proxies for UK listed companies. As a result, the trust owns some of the world's leading companies with great long-term growth prospects in their respective industries. Stocks held include Total Energies, Microsoft, Novo Nordisk, and Nestlé. These holdings have been performing strongly, so the managers have increased exposure to overseas names, and they have recently added a position in MasterCard, and the percentage of foreign stocks has risen from 15% to 19%.
Thanks. And what challenges does the trust currently face?
Well, I would say that the main challenge is that the UK market is currently out of favour with both domestic and foreign investors. But this does mean that UK equities are attractively priced.
What other factors aside from price might attract investors back to this market?
It's possible that market sentiment may improve if the Bank of England begins to cut interest rates. Investors will also certainly welcome any signs that the economy is gathering momentum. And once the forthcoming UK general election is over, political uncertainty is likely to diminish. So this could also help. As would a pickup in M&A activity, as this would send a clear signal to the broader investment community that some major investors see value in the market.
And how are the trust managers feeling about the outlook for the trust?
Its managers are optimistic about the prospects of both the UK market and the trust over both the short and the longer term, even though the near-term economic outlook is rather lackluster. In the short term, the managers expect the trust's quality focus to protect returns, as companies with pricing power, high margins, and strong balance sheets are best placed to weather challenging economic conditions while continuing to generate income. Looking further ahead, the managers argue that the UK market now looks very cheap compared to its own history and relative to international markets, and they believe that at some point investors will come to appreciate the value it offers. To support this view, they cite the UK market's 4% dividend yield, which is certainly appealing versus regional equity markets. They also expect dividends and earnings to grow strongly this year, despite subdued economic growth. In short, they believe the case for investing in the UK market is compelling and will eventually tempt investors to return. And they expect their quality holdings to do better than others as and when this tide turns.
Do you see any other factors that might support Murray Income Trust's longer-term prospects?
Yes, I do. Its portfolio has exposure to several long-term structural trends, such as aging populations, digital transformation, the transition to renewable energy, and rising global wealth. These trends should provide major tailwinds for earnings and dividend growth over the medium term.
Finally, what about the trust's discount?
Its discount is currently around 10%, double its long-term average. The board has responded to this development by stepping up share buybacks to support the share price and reduce discount volatility. These buybacks should, over time, have a favourable impact on the discount. So too should any sustained improvement in performance and any improvement in investor sentiment regarding UK equities. There are therefore several reasons to suggest that the trust discount may, in time, move back towards its long-term average. So for those who share the manager's confidence in the longer-term prospects of the UK market and the portfolio's holdings, now might actually be a good time to gain exposure to the regular income, capital growth, and relative value offered by this trust.
Thank you, Joanne. I think you've given us a great rundown on what the trust has to offer. You've been listening to Uncovering Trusts, a podcast by Edison Group. If you would like to find out more about Murray Income Trust and other investment companies we cover, please visit edisongroup.com. Thank you.